Hi, good morning to all. In this video, I am going to discuss about basics of day trading. In Indian stock markets, there are a number of people doing day trading in every day. There was a time years ago when the only people able to trade actively in the stock market were those working for large financial institutions, brokerages and trading houses. The arrival of online trading along with the instantaneous dissemination of news high-leveled the playing, or should we say trading field. The easy-to-use trading apps and 0% commission of services. Day trading can turn into a lucrative career, but it can be challenging for novices, especially those who don't have a well-planned strategy. And be aware that even the most seasoned day traders can hit rough patches and experience losses. Day traders buy and sell stocks or other assets during the trading day in order to profit from the rapid fluctuations in prices. Day trading is often informed by technical analysis of price movements and requires a high degree of self-discipline and objectivity. Intraday trading, also called day trading, is the buying and selling of stocks and other financial instruments within the same. In other words, intraday trading means all positions are squared off before the market closes and there is no change in ownership of shares as a result of the trades. Until recently, people perceived day trading to be the domain of financial firms and professional traders. But this has changed today thanks to the popularity of electronic trading and margin trading. Today it's very easy to start day trading. If you want to start, read and to understand the basics of intraday trading. Trading of any kind has its own set of rules. Here are the basic rules that every intraday trader needs to keep in mind. Day trading means buying and selling a securities within a day or even within seconds. It has nothing to do with investing in the traditional sense. It is exploiting the inevitable up and down price movements that occur during a trading session. Day trading is most common in the stock market and on the foreign exchange where currencies are traded. Many of them add an additional level of risk by using leverages to increase the size of their stakes. Trading based on the news is one popular technique. Scheduled announcements such as the release of economic statistics or interest rate announcements are subject to market expectation and market psychology. Intraday trading is high risk. It is advisable you only invest what you could afford to lose. Selecting the right value for entry and exit is crucial. This helps in setting an escape value for a crisis situations. The share market does not necessarily trend in a predictable manner. Intraday trading is dynamic. Keeping a track of your performance, wins and losses will help you understand what went right and what didn't. Evaluation of past performance will help you make better trading decisions in the future. Following the trend. Anyone who follows the trend will buy when prices are rising or short sell when they drop. Following the trend. Anyone who follows the trend will buy when prices are rising, short in this place, sell when they drop. The another method is scalping. This technique normally involves entering and exiting a position quickly. Within it may be minutes or even seconds. Should you start day trading? Make sure you come in with some knowledge of trading world and a good idea of your risk tolerance, capital and goals. Be prepared to put in the time to practice and perfect your strategies. Start small. Focus on a few stocks rather than wearing yourself thin. Going all out will complicate your trading strategy and can mean big losses. Stay cool and try to keep emotions out of your trades. Don't deviate from your plan. This is important. Everybody told why day trading is controversial. The profit potential of day trading is an oft debated topic. Some people day trade without sufficient knowledge. But there are day traders who makes a successful living despite or perhaps because of the risks. Many professional money managers and financial advisors shy away from day trading. Profiting from day trading is possible, but the success rate is inherently lower because it is risky and requires considerable skill. And don't underestimate the role that luck and good timing play. A stroke of bad luck can sink even the most experienced day trader. Intraday strategies. Scalping. This strategy focuses on making numerous small profits on ephemeral. It means short period of time price changes that occur throughout the day. Range trading. Next one is range trading. This strategy uses predetermined support and resistance levels. Support and this is the support. This place is the support. This place is the support. This place is the resistance in prices to determine the traders' buy and sell decisions. News-based trading. This strategy seizes trading opportunities from the heightened volatility that occurs around news events. High frequency trading means this strategy uses sophisticated algorithms to exploit smaller short-term market inefficiencies. Who should participate in intraday trading? Those who can take risks and have enough time to follow the market closely, and time traders. Intraday trading promises high returns and thus may sound very attractive, but it also carries a higher risk compared to the delivery segment. So, if you have a day job that requires your full attention for most of the trading hours, you may want to avoid intraday trading. You have to watch the market and time your trades to perfection. You need a good understanding of and time to perform technical analysis and daily charts to make the right decisions. Higher margin available to traders compared to investors. High return potentials. Low brokerage charges. Do analysis if you are ready to witness high risk and are willing to put extra effort into analyzing markets behavior on a daily basis. What kind of stocks to choose for intraday trading? In intraday trades, you need to square off your positions before the market closes. The market starts at 9:15 a.m. to 3:30 p.m. But it square offs your positions at 3:20 p.m. So it is essential that you choose stocks that have enough liquidity for executing such trades. This is why many recommended high liquid stocks like large cap stocks. This can also minimize the chances of your trades impacting the share price of the selected stocks. Risks of day trading. For the average investors, day trading can be a daunting proportions because of the number of risks involved. You are always be preferred prepared to suffer severe financial losses. Day traders typically suffer severe financial losses in their first months of trading, and many never make a profit. Next one is, day trading is an extremely stressful full-time job. Watching dozens of ticker quotes and price fluctuations to spot fleeting market trends demands great concentration. Day traders depend heavily on borrowing money. This is the biggest problem. Day trading strategies use the leverage of borrowed money to make profits. Many day traders, many day traders not only lose all of their own money, they wind up in debt. What is the first rule of day trading? The first rule of day trading is never to hold onto your positions when the market closes for the day. Win or lose, sell out. You should out from the market that day. Most day traders make it a rule never to hold a losing positions overnight in the hope that part or all of the losses can be recouped. For one thing, brokers have higher margin requirements for overnight trades, and that means additional capital is required. Here's a good reason for that. A stock can go down or up on overnight news, inflicting a bigger trading losses on the owners of shares. You need sufficient capital. Wise day traders use only risk capital that they can afford to lose. This protects them from financial ruin and helps eliminate emotional from their trading decisions. A large amount of capital is often necessary to capitalize effectively on intraday price movements. Adequate cash is required for day traders who intend to use leverage in margin accounts. Volatile market swings can trigger big margin calls on short notice. Trading tips for beginners. Day trading is only profitable in the long run when traders take it seriously and do the research. Day traders must be diligent, focused, objective, and unemotional in their work. Day traders often look at liquidity, volatility, and volume when deciding what stocks to buy. Some tools that day traders use to pinpoint buying points include candlesticks, chart patterns, trend lines, and triangles, volume based, support and resistance based, pivot based tradings. These are all the important tools that day traders use to pinpoint buying. Knowledge is power. You must have basic knowledge about trading. Next one is set aside funds. Many successful day traders risk less than 1% to 2% of their accounts per trade. Set aside time. Next one is set aside time. You will need to give up most of your day. This is important. Start small. Smaller amounts that you wish to invest. Next one is avoid penny stocks because of low liquidity. Limit orders. Executed as your wish. Be realistic about profits. Many successful traders may only make profits on 50% to 70% of the trades. No one become 100% of their trades. Stay cool. Next one is stay cool. Decision should be governed by logic and not emotions. Stick to the plan. Follow your formula closely rather than try to chase profits. What makes day trading difficult? Day trading takes a lot of practice and know-how, and there are several factors that can make it challenging. Also, as a beginning day trader, you may be prone to emotional and psychological biases that affect your trading. For instance, when your own capital is involved and you are losing money on a trade. Next is discipline is most important one. Every trader should follow the discipline. Many day traders end up losing money because they fail to make trades that meet their own criteria. As the saying goes, plan the trade and trade the plan. Success is impossible without discipline. To profit, day traders rely heavily on market volatility. A day trader may find a stock attractive if it moves a lot during the day. That could happen for a number of different reasons, including an earning report, investor sentiment, or even general economic or company news. To identify when to exit, you can look at two conditions: when you have reached the target profit or when you have reached the maximum loss limit below which you don't want to go. Once you have reached the profit level you can consider making an exit. Have a stop loss always. An offshoot of the first point, always have a stop loss. Having a stop loss is a type of exit strategy. If in case your trend or expectation doesn't come true, on the other hand, if your expectation comes true, you should know how to have different target levels, T1, T2, etc., so that you keep exiting at various price points. Factors in historical return. We all believe that fact that history repeats itself. While this can't be said with 100% certainty. It may be 70, 50 or etc. Usually, stocks also follow their historical path. Thus, the aim should be to find a name that preserves the capital and at the same time provides returns at a controlled risk. You may choose to start trading a few names initially after analyzing the trend and understanding its characteristics. Also, remember to choose a liquid name that has a high average daily value. This ensures that you will be able to find buyers while exiting. Avoid penny scripts. You should avoid penny scripts. Penny stocks provide very high returns, but at the same time come with high volatility. As you are a beginner, you should avoid penny scripts owing to the high risk of capital loss. Once you are comfortable with the strategy, understand trends well, you may enter the segment. You always remain calm. Since intraday trading requires you to be hyper vigilant about the market, it surely brings with it anxiety. However, don't let it get the better of you. Trades and decisions should be based on logic and rational. Emotions such as fear, greed, attachment should be kept at bay. Alternatives to day trading. As mentioned previously, intraday trading looks lucrative but comes with a high degree of risk. So what are the other options if you wish to switch? Some of the alternatives to intraday. Swing trading. In this, usually the investor play for a few days or weeks in swing trading. It can be considered the right way for people looking to diversify. Some doing short-term trading and to investing. These are all the examples of alternatives to day trading. How is intraday trading different from regular trading? How is intraday trading different from regular trading? There's only one difference between a regular trade and an intraday trade. It lies in taking the delivery of the stocks. In intraday trading, you square off your positions on the same day. It may be 3:30 or 3:20 p.m. So your sell order offsets your buy order. This way, there is no transfer of ownership of shares. A regular trade gets settled over a span of days, if not longer. So you get delivery of the shares you bought while the shares you sold move out of your demat account. Test your strategy. You have defined how you enter trades and where you will place a stop loss order. Now you can assess whether the potential strategy fits within your risk limit. If the strategy exposes you to too much risk, you need to alter it in some way to reduce the risk. If the strategy is within your risk limit, then testing begins. Manually go through historical chart to find the entry points that match yours. Note whether your stop loss order or price target would have been hit. Paper trade in this way for at least 50 to 100 trades. Determine whether the strategy would have been profitable and if the results meet your expectations. If your strategy works, proceed to trading in a demo account in real time. If you take profits over the course of 2 months or more in a simulated environment, proceed with day trading with real capital. If the strategy isn't profitable, start over. Finally, keep in mind that if you trade on margin, you can be far more vulnerable to sharp price movements. Trading on margin means borrowing your investment funds from a brokerage firm. It requires you to add funds to your account at the end of the day if your trade goes against you. Therefore, using stop loss order is crucial when day trading on margin. What to buy? Liquidity. A security that's liquid allows you to buy and sell it easily and hopefully at a good price. Liquidity is an advantage with the tight spreads or the difference between the bid and ask price of a stock, and for low slippage or the difference between the expected price of a trade and the actual price. Volatility. This is a measure of the daily price range, the range in which a day trader operates. More volatility means greater potential for profits or loss. Trading volume. This is a measure of the number of times a stock is bought and sold in a given time period. It's commonly known as the average daily trading volume. A high degree of volume indicates a lot of interest in stocks. An increase in a stock's volume is often a harbinger of a price jump, either up or down. When to buy? The real-time news services. News moves stocks, so it's important to subscribe to services that alert you when potentially market moving news breaks. Intraday candlestick charts. Candlestick provides a raw analysis of price action. Day trading charts and patterns. 3 common tools day traders use to help them determine opportune buying points are candlestick charts patterns, including engulfing candles and dojis, other technical analysis, including trend lines and triangles, volumes, support and resistance. There are many candlestick setups a day trader can look for to find an entry point. If followed properly, the doji reversal pattern is one of the most reliable ones. A volume spike on the doji candle or the candles immediately following it, which can indicate that traders are supporting the prices at this level prior support at this price level, such as the prior low of day or high of day. And finally, intraday is not very easy, and this guide should be used only as a starting point to delve deeper into this trading type. It is also important to note that this type of trading is not suited to all stocks market traders or investors. If you want to explore intraday trading, start with a small trade volume to protect yourself from market risks. Also, make sure your technical analysis basics are strong so that you are able to take wise buy and sell decisions. However, if you want to take benefits from the stock market, you can start investing rather than trading. Stock investing involves assessing a stock based on fundamentals and the holding onto your investments for long-term wealth prospects. That way, you don't have to constantly watch and time the market, and it can save you a lot of anxiety as well as possible capital loss. In any case, whichever strategy you select, make sure you enter stock markets with a thorough preparedness, know fully well about the risk, and remain calm and composed. Thank you to all.